So we have finally an end to the longest US government shutdown in history, but not, it seems, an end to the chaos. Unfortunately, just as I suspected, markets are not happy, apparently, about the end of this shutdown. And I'm going to break down exactly why in just a moment. First of all, as we always do, let's start with a look at the markets. And we can see Bitcoin has broken the floor, it seems, unfortunately, currently trading at a price of about $97,500. We have broken out of this sort of micro uptrend that we put in since the lows on November the 25th. And we are now pretty much in free fall, although I will say the breakdown hasn't been terribly dramatic, more of a slow bleed. If we just zoom that out to the 1 day time frame, you can see we have also broken this level here, this key level put in on the 21st of June of this year. And we are now basically coming into this value gap, all right? I think the next place I would be looking for buy side liquidity is unfortunately going to come in somewhere around this pocket here, around the mid $95,000 mark. And of course, the fire was fueled, as always, by liquidations. Nearly $900 million worth of long liquidations over the last 24 hours. I don't know how people still have money and the inclination to throw at this. Although I suppose on balance, it's not really money that they're throwing at this. It is borrowed money that they're throwing at this. And that is why they're getting liquidated constantly. The same pattern, the same story, just a different day, just a different catalyst in this situation, unfortunately. And that is retail jumping in with money that they don't have on too much leverage and getting absolutely wrecked when that position goes against them. $600 million plus worth of those long liquidations were in the last 12 hours alone, and about $300 million worth in just the last 4 hours. Unfortunately, as to be expected, I don't know what else to say at this point. People still have the inclination to over leverage themselves in this market. It's unfortunate, but it is true. And if we look at the liquidation map now, you can see the fire has, or the fuel has pretty much run out, at least on the daily time frame. So we're looking at pretty small cumulative long liquidation risk. But once again, the shorts are stacking up. So just on the daily time frame here, looking across all exchanges, that is peaking out at over $4 billion worth of cumulative short liquidation risk. And if we zoom this out to the 30-day, of course, there are a lot of shorts stacked up in the market, back to nearly $15 billion worth versus a really kind of negligible, contextually negligible $1.7 billion worth of long liquidation risk. So what's happening? We have, of course, seen an end to the longest US government shutdown in history. Trump signed this bill about 12 hours ago, but markets aren't happy about it. And we can see just in the last 12 to 24 hours or so, the S&P is down nearly 2%, which is a pretty big move for the S&P. And what this all comes down to basically is exactly what I proposed in the last couple of videos, and that is unfortunately the jobs and specifically unemployment data release and not release, and that whole fiasco. So first, we had the White House coming out and saying that the October jobs report is likely to not be released to the public at all, ever. Then we had a bit of a backpedal on that, and now the story is saying that the White House is telling us that the October jobs and inflation data may never be released. Pardon me, this is the wrong headline, but since then, it's looking like we're going to get that report, but it's going to lack the unemployment rate. So just to give you the too long didn't read on this, first of all, basically, there's no reason to withhold that data. Okay, if we take it at face value, it's because the disruption from the government shutdown means that data doesn't exist. I'm not certain if I'm buying that. I think a lot of the market isn't certain if they're buying that. And it's looking like this is being potentially withheld because the data is so bad. And the data from those 3 missing data points, those 3 key releases that we missed, that is September, October, and November, is going to paint a downward trend in employment in the US and an upward trend in unemployment, layoffs, and that is going to look really bad, and it's going to look like we're kind of pointing towards a recessionary environment, which obviously is not a good thing at all. The October jobs report in the United States will be released without an unemployment rate reading, according to the National Economic Council Council Director Kevin Hassett. The absence of this key data point is due to the government shutdown, which prevented the household survey from being carried out during October. That's how they collect this data. This survey is essential for calculating the unemployment rate. And of course, we know that this is really key data for the Fed setting monetary policy. They are, in Fed Chair Powell's words, driving a car without headlights at the moment. And we can see that the odds of a rate cut at the next meeting are now down to 50.7%. Okay, call it 50-50, right? It is totally in the balance if we're going to see that rate cut or not. Ironically, if this jobs data came in bad, it would actually be more likely that we see that rate cut. But as always, keep coming back to, markets just don't like uncertainty. So unfortunately, we're in this situation now where the markets didn't like the uncertainty of the government being shut down, and they also don't like the uncertainty of the government being reopened and that key jobs data being withheld or not released, or whichever way you want to look at it, whether it's nefarious window dressing or whether it is just an honest lack of the data. Either way you break it down, it kind of amounts to the same thing, which is that we are missing key data on which monetary policy decisions are made, and that is not good for the markets right now. It's also potentially going to paint a pretty bad picture about markets going forward into the future. So looking a few steps ahead from this, we are due the November jobs report out. We are due to have that October data out next week, and we are still, of course, missing September and October. When we do finally get that, if we do go into a recessionary environment in the US, as a lot of pundits are calling for, how do we look at that with Bitcoin and crypto? So naturally, the oldest recessionary hedge has been gold. And then we have seen historically Bitcoin behaving a little bit like gold, but more recently Bitcoin behaving a lot more like a classic risk asset, a lot more like equities. So really what we're going to see from this is kind of in the balance, okay, in two minds there. And I think we need more clarity, obviously, to see what's going to happen. In any case, I wouldn't be making investment decisions right now on the basis of no data. But at least in the mid to short term, this sell-off, at least in terms of a crash sell, right, a liquidation event, seems to be slowing down just because, of course, there isn't that much leverage left in the market right now. But as ever, unfortunately, I think if we do see a bounce out of liquidity at some of the levels I mentioned earlier, it is likely we get a load more retail jumping in, leverage long on that, and then it sets up the house of cards again to fail, unfortunately. We could get that jobs data and it could be really good, and although that would potentially lower the chances of another rate cut, we've also got other factors to consider, like the odds of the Fed going back into quantitative easing, i.e. printing money, i.e. more liquidity coming into the markets. But that's where we are right now. Not a great day for data, not a great day for crypto to be making big decisions. But as always, thinking long term, thinking a couple of years ahead, any sell-off represents better pricing for anyone who's interested in this long term. There we go. Not making any rash decisions right now. Of course, that is just my opinion, purely sharing it with you for entertainment purposes. But I hope you found that interesting. Hope you found that useful. Plenty more to come. Catch you in the next one. Bye.